The Monetary Authority of Singapore on 15th July reported a net profit of 19.7 billion Singapore dollars for the financial year ended 31st March, surging from 3.8 billion Singapore dollars a year earlier. This sharp rise was driven by 31.4 billion Singapore dollars in investment gains, offset partly by a 3.4 billion Singapore dollars currency translation loss due to the stronger Singapore dollar, and 8.3 billion Singapore dollars in expenses from active money market operations to manage banking system liquidity. MAS Managing Director Chia De-jun said the results reflected broad-based resilience across global markets, with strong returns from bonds, equities, and developed and emerging economies. Deputy Managing Director Jacqueline Loan noted that equities in particular exceeded expectations on the back of global growth and falling inflation. Despite April's market turbulence sparked by U.S. tariff threats, Chia observed that conditions stabilized as equity markets rebounded, credit spreads tightened, and Asian currencies strengthened. He cautioned, however, that markets remain vulnerable to sharp corrections if trade conflicts or geopolitical tensions escalate further. No transfers were made to the government's consolidated fund this year, as MAS prioritized reinforcing its own balance sheet in an uncertain global environment. Chief Economist Edward Robinson projected low and stable inflation into 2026, supported by weak imported inflation, slowing domestic costs, and softer consumer spending. He noted that slowing global demand should keep imported goods inflation modest, while excess regional output will help contain price pressures in Southeast Asia. Locally, wage growth is expected to ease alongside productivity improvements and household consumption cooling, bolstered by government subsidies. However, Chia cautioned that inflation risks remain two-sided. Disinflationary forces could strengthen if tariffs drag down global trade, while new geopolitical or supply chain shocks could send prices higher. This year, MAS stress-tested more severe scenarios and concluded that overall, corporates and households remain resilient. But Chia advised smaller export-oriented businesses and households with variable incomes to exercise caution and avoid taking on large new loans in the current environment. Singapore's financial services sector expanded 6.8% in 2024, outpacing the 3.1% growth of 2023 and averaging 4.7% annually between 2021 and 2024. Banking remained robust. Insurance assets climbed 3.6% to 456.4 billion Singapore dollars, and Singapore strengthened its position as Asia's leading FX hub. The corporate debt market also posted strong growth, while assets under management surpassed 6 trillion Singapore dollars for the first time, rising 12.2% amid inflows to both traditional and alternative investments. Chia stressed that while Singapore's wealth management remains resilient, MAS will stay vigilant to prevent illicit financial flows even as it welcomes legitimate capital. He added that the recent pace of growth is unlikely to continue, given global uncertainties and softer financing demand. In technology, MAS completed its quantum key distribution sandbox with banks and technology firms to explore quantum-safe encryption, anticipating future threats from quantum computing. It also pledged an additional 100 million Singapore dollars under the Financial Sector Technology and Innovation Scheme to build capabilities in quantum technology and artificial intelligence. The authority launched Pathwin.ai, a collaborative program bringing together 20 institutions across banking, insurance, capital markets, and payments to share AI best practices and use cases. In December 2024, MAS released a guidance paper on managing generative AI risks, outlining frameworks for ethical governance, bias control, validation and monitoring, and emergency kill switch measures.